Hi, this is O'Connor. Welcome back. And it is amazing that we're getting around to the top of this framework and all the way over to the top left-hand side. Fraud against organizations, consumer and e-commerce fraud. This is the home straight where we look at chapter 14, 15, and 17. Let's get into chapter 14, which is fraud against organizations. The last three learning modules, financial statement fraud, looked at fraud on behalf of organizations. Now we're looking at fraud against organizations. What do I mean by that? Well, the learning objectives is for you to have a better understanding of occupational fraud and for you to be able to describe the nature of various types of asset misappropriations and to be able to discuss the nature and various types of corruption. And so in a nutshell, compared to the last learning modules, we are looking at fraud against the organization. That is occupational fraud, that is corruption and asset misappropriation. The previous learning modules looked at fraud on behalf of organizations against shareholders and other external stakeholders. And basically what you have here, this framework, is the best way of delineating the classifications of occupational fraud from fraud on behalf of the organization, that is financial statement fraud. And as you'll see that asset misappropriation branches out into different types, so does corruption. Let's get into this area of occupational fraud, bearing in mind, I'm going to be referring to statistics from the Report to the Nations 2024, published by the Association of Certified Fraud Examiners. So the materials in this slide deck come from that source. So as I said, occupational fraud is really management fraud against the firm or employee fraud against the firm. Financial statement fraud is management fraud on behalf of the firm. Why does this matter? Okay, we know that financial statement fraud makes up the bulk of fraud losses across all companies around the world. If we look at the data of these three types of fraud, financial statement fraud is the largest with a median loss of 766,000. Next, corruption, a median loss of 200,000. Finally, asset misappropriation, a median loss of 120,000. Now, of course, that's in terms of the losses. Financial statement fraud make up the bulk, less so corruption, less so asset misappropriation. However, if you talk about the number of fraud incidents, then asset misappropriation, then corruption, then financial statements, it goes the other way. But if we talk about losses, it is the way of this pyramid. So what do we mean by occupational fraud and the fraud statistics related to the loss? Well, if we break down occupational fraud into asset misappropriation and corruption, you can see out of the 1,309 asset misappropriation cases, a lot of them are related to non-cash billing, cash on hand skimming, expense reimbursements. There were 662 cases of corruption and 61 cases of financial statement fraud. So there you have the counts. And then on the other hand, the losses are ginormous when we talk about financial statement fraud compared to corruption and then compared to asset misappropriation. What about fraud statistics related to the detection of occupational fraud? Okay, detection and the time it takes to detect fraud is much shorter if you have surveillance and monitoring in the organization. Now we're going back to learning module 3 and 4, where we talked about prevention and detection before we talked about fraud investigation. Remember that? It was always better to invest in prevention and detection because fraud investigation is very expensive. Surveillance and monitoring shows that it's catching the fraud on average within 6 months. Automated transaction data monitoring is catching in 6 months. Account reconciliation, 9 months. Internal audits, document examinations, tips are revealing frauds within 12 months. And then management review by accident and so forth, it's taken longer for the fraud to be detected. So this ties back into Learning Module 4 and 5, where we looked at prevention and detection. Haven't mentioned prevention. That is the next slide. Detection comes after prevention. So let's move on to prevention. And the fraud statistics related to prevention are as follows. If we put in these programs, prevention programs in place, it shows you what anti-fraud controls are most common in organizations that have reported fraud. So what is most common is a code of conduct. Interesting, because we talked about that in Learning Module 4 and 5 about creating a culture of honesty, openness, and assistance as being a preventative measure in any organization. Having a hotline is very effective. Having an independent audit committee is effective. Surprise audits are effective. Rewards for whistleblowers less so. Job rotation less so. So if we stay above the 75 quartile or the 75% and higher, then it's code of conduct, having an external audit, having internal audit department, and management certification of financial statements. So these are things that companies have in place in this report to the nations. As they summarize, certain anti-fraud controls have a significant impact on organizations' exposure to fraud. So we can call these anti-fraud controls, both prevention and detection. So the next question is, do they work? Okay, this is just showing you whether companies have these different mechanisms in place, but do they work? Let's go back to the Report of Nations in our next slide. In the light blue shows the companies that had these controls in place, these prevention controls in place, and I mentioned a few of them in the previous slide, on average had a much lower or significantly lower median fraud loss compared to those companies that did not have prevention controls in place. And there you have it. Like, this is prima facie evidence that you should be investing in prevention controls to minimize opportunities for fraud. Let's have a look at the fraud statistics related to organization size. And as you would guess, while the median loss suffered by small organizations is no different from large, it's likely to have a much larger impact on a small organization because they have a smaller footprint and less resiliency to survive such a loss. Also, noted here that the size of the loss caused by occupational fraud is strongly related to the perpetrator. If the perpetrator are in management or senior management positions, the size of the loss associated with occupational fraud is much larger than if it was perpetrated by an employee. Let's move on to asset misappropriations. And basically what we're going to do now is go back to the basic classifications and terminology of how to describe different types of occupational fraud. Asset misappropriation is another word for occupational fraud. And what you've got here is kind of an in, a during, and an out process. Kind of see it as a process. And very, very simply, any fraud associated with taking money before it reaches the organization, we call skimming, like skimming the top of the water for any bugs or anything like that. You're skimming that money before it comes into the organization. Any misappropriation of money or assets after they come into the organization, we call larceny. So that's inside. Finally, any misappropriations of funds going out, we call disbursement fraud. And so there are different types of skimming schemes. There are different types of larceny schemes, and there are different types of disbursement schemes. So you got the in, you got the during, and you got the out. And that's the best way to understand what we mean by skimming, larceny, and disbursement fraud. You could say S, L, and D, all right, and make up a word out of that. All right. In the textbook, they actually group skimming, larceny, and fraudulent disbursements in a different way. And I find it can be confusing because they've got larceny on this side, they've got fraudulent disbursements in the middle, they've got skimming on one side, they've got larceny on the other side. So I showed you the procedural view where you have skimming, larceny, disbursement. These are the same words, and here are the definitions as I have explained. If we move on and group them according to fraud cases in the report to the nations, you can see that in terms of the size of the frauds are largely made up by fraudulent disbursements, check payment tampering, billing, expense reimbursements. Larceny making up a smaller amount, that is stuff that's already inside the organization and you're stealing from that. And skimming is a small amount as well. So fraudulent disbursements make up a large portion of the fraud cases in the report to nations. What the textbook says about this is that when larceny occurs, remember larceny, working on fraudulently accessing and stealing assets inside the organization, it occurs, cash is stolen by employees or others after cash is recorded in the company's accounting system. As a result, larceny schemes are easier to detect. By contrast, skimming schemes are much more difficult to detect because you may not know how much was skimmed off the top, because all you have is a record of the post-skimmed amount coming into the organization. Wow. If we look at the theft of cash through skimming, as it's defined in the textbook, any scheme in which cash is stolen from an organization before it is recorded on the organization's books and records. The basic skimming scheme is taking money from the sale of goods or services but making no record of sale. More complicated schemes are where we understate the amount received, or we misappropriate customer payments and write off the receivable as uncollectible, or we might embezzle the first customer's payment and take the second customer's payment and use that as a replacement deposit for the first customer's payment. And that is called lapping. In other words, that is exactly how a Ponzi scheme works. So you could say that a Ponzi scheme inside the organization is what we call lapping. Wow. All right. So if we go back to our graph again, if we look at fraudulent disbursements as it is explained in the textbook, the Association of Certified Fraud Examiners found that fraudulent disbursements comprised by far the highest percentage of asset misappropriations, as I said earlier. And then they identify in the textbook 6 different fraudulent disbursement schemes: billing, check tampering, expense reimbursements, payroll, wire transfer, and register disbursement schemes. Each of these are set out in a table in the textbook, as we see in the following 2 slides. And I'll give an example of one or the other, but a classic one is a billing scheme where a person causes his or her employer to issue a payment by submitting invoices or fictitious goods or services, inflated invoices, or invoices for personal purchases. This reminds me of that case back in chapter 3, chapter 4, where the disbursement manager created 20 fake doctors for medical bills to be sent to. And in the process, embezzled millions of dollars before she was caught. That was a billing scheme. There is check tampering, where a person steals his or her employer's funds by forging or altering a check on one of the organization's bank accounts, or steals a check the organization has legitimately issued to another payee. Expense reimbursements, any scheme in which the employee makes a claim for reimbursement of fictitious or inflated business expenses. Wow. Let's go to the second list, and I'll go through these quickly. Payroll, where an employee causes his or her employer to issue payment by making false claims for compensation. Wire transfers, any scheme in which a person steals his or her employer's funds by fraudulently wire transferring them out of the employer's bank accounts. And cash register disbursements, any scheme in which an employee makes false entries on a cash register to conceal the fraudulent removal of cash. And this is where you might see in restaurants or retail establishments, they have a sign to say you will be given a reward of $20, $40, $50, $100 if you are not given a receipt for any cash that you have received, because the employer, who is not monitoring the cashier, wants to guarantee that the cashier rings up your purchase in the cash register and produces a receipt and gives it to the customer. So you, the customer, you become the monitorer of the employee, taking your cash and ringing it up on the register. You, the customer, in effect, are controlling the opportunity for the cashier to take your cash without ringing up on the register. So keep that in mind when you go shopping in your future travels, especially in countries that may not take electronic payments. We know electronic payments are big these days, but still for restaurants that take cash. That's what they do to control fraudulent schemes where cash is stolen at the point of transaction. Let's move on to executive cash frauds. A lovely example in the textbook where they bring up Tyco scandal again. Remember, Tyco was one of the top 25 in financial statement frauds, and the usual suspect rears its head again, but in a different way, because here the executives, they not only fudged the financial statements, as we explained in Learning Module 13, the previous chapter, but they also engaged in occupational fraud against the organization by giving themselves loans and hiding those loans from the company, Tyco, and then spending those loans on lavish perquisites, a Park City ski chalet, as we can see, and Central Park West apartment. And in the end, they didn't pay the loans back. They got Tyco to forgive those loans. So this is not financial statement fraud per se. This is occupational fraud, because they're taking money directly from the organization. So they participated in two types of fraud: financial statement fraud on behalf of the organization and occupational fraud against the organization. Wow. Didn't they have enough by just committing one? No, they went and had to commit two frauds. Wow. So you better read about this Tyco scandal, because this you only see in the movies. But then again, what we saw around the turn of the century, there was a lot of movie making material, weren't there? I want to finish up this first section of asset misappropriation, and that is by looking at how people can misappropriate company assets other than cash. And there are two ways. The first way is by misusing company assets. That is, you use the car for your personal purposes without the employer knowing. You use a computer, you use company supplies for your own personal purposes to conduct your personal work on company time. that is one way of misusing the company's assets. Another way people can misappropriate company assets other than cash is associated with the theft of inventory or just the theft of those assets. And so non-cash types of frauds in this case include inventory, information, and security. And just a final example, inventory fraud, any scheme involving the theft or misappropriation of physical non-cash assets such as inventory, equipment, or supplies. So again, this is theft. We're not using the car in our personal time. That is the other form of misuse of company assets. Information, again, if you're in a service industry particularly, where the employee steals or otherwise misappropriates proprietary, confidential information or trade secrets. Finally, any scheme involving the theft or misappropriation of stocks, bonds, and other securities. And so that closes up what we mean by occupational fraud, where we looked at asset misappropriation. What we're going to do in the next section is look at corruption and describe some of the areas of corruption that you need to be aware of. Stay tuned and see you soon.